Ladies and gentlemen, you are going to be rich in this lifetime as long as you do not give up. If you are focused on trading, realize that one day you will have the opportunity to make more than doctors, more than lawyers, more than lots of people that go to school for years upon years to get these degrees to give them the opportunity to earn six-figure salaries, 300K a year, 400K, 500K a year, things like that. Realize that one day you will have the opportunity to make more than $1 million per year. Realize that just as long as you don't give up, you will reach that peak. As long as you never give up, you keep practicing, getting better, you keep failing until you succeed, you guys. Ladies and gentlemen, you will make it. I promise you, you will make it in this lifetime. Just keep going hard, traders, every day. We're going to be taking a 5%ers 100K prop firm challenge, and I'm going to be sending every single trade that I take as like a signal, if you will, and I'm going to be sending that to our free Telegram group. The Telegram link is going to be in the description below of this video. I'm also going to leave it in the comments down below. Go join that Telegram group. It's free, you guys. I will be sending every single trade so you kind of know what I'm looking at. You can enter with me if you want. Again, this is not financial advice. I am not a financial advisor whatsoever, but I understand a lot of people find value in getting trade setups from other good traders. You know what I mean? I like to believe that I am a pretty good trader myself, and I want to provide you guys value not only through mindset, psychological approaches to these videos, also analysis, providing you good risk management systems, and also providing you setups that I am taking myself. Okay, again, not financial advice whatsoever, but in this video, we're going to be talking about the only ICT strategy that you will ever need, promise you. But first, I want to talk about the psychology of winning and consistently profitable traders, okay? The core traits of winning traders is one, emotional mastery. Profitable traders, they do not let emotions drive their decisions. They know how to stay calm after wins and losses. They avoid revenge trading or over trading. They control fear, greed, and FOMO, which is the fear of missing out, and they stick to their plan under pressure. Okay. Secondly, they have discipline over everything. They trade only when conditions match their setup. If there is no setup, then there is no trade. Okay. They respect their stop loss and their take profit levels. They follow their risk management rules with no exceptions whatsoever. And they log every trade and constantly refine based on performance, not emotion. Okay. And then third, they practice this patience and delayed gratification. They understand that trading, it's a probability game. It's not a get rich quick scheme, okay? They wait for quality setups. They're content taking just a few great trades per week or even per month. They focus on long-term account growth, not daily profits, okay? Now, how do winning traders think? They think in probabilities, not absolutes. Okay. They accept losses are a part of this game. Every trade, it's just one outcome in a long series. Okay. They don't chase perfect setups. They execute based on their edge. Okay. And I'm going to show you a pretty solid edge here in this video as well. You want to have a mental shift like them, which is this trade might lose, and that's okay as long as I followed my system, right? They focus on the process, not just profits, okay? Winners, they obsess over execution, not outcome. They ask, did I follow my plan? Profits, they're seen by like as a byproduct of a consistent behavior. It's not luck, okay? They detach from money emotionally. They don't obsess over gains whatsoever or panic over losses, okay? They treat trades like probability driven business transactions every single time. The focus is always on protecting your capital and compounding it over time. That's the focus, right? So, what are some winning trader habits? They journal and they reflect. They document why they entered a trade, what they felt, how they felt, and what happened. Okay. They review losing and winning streaks for certain patterns. Okay, journaling, it keeps them grounded and self-aware as traders. Okay, and they have a routine, right? They have a pre-market prep where they're checking news and reviewing different levels and areas of sensitivity. They have this mindset check, like they avoid distractions and stress. I like to do this through meditation, a 5 minute meditation. If you don't know how to meditate, look up a guided meditation on YouTube. That's what I like to do. It just helps me to kind of really focus and relieve myself of all my other thoughts externally and focus in on my trading, right? And then they do this post market analysis. They treat trading like a business, not a gamble, okay? A lot of traders, they're losing traders because they treat it like it's a gamble. And winning traders, they focus on continuous improvement. They invest in education, they review back tests, they watch their own behavior like a coach watches a player, okay? You're pretty much just coaching yourself every single time. The key mindset to have is the market doesn't beat me, I beat myself, so I need to master myself first. Okay? That's the mindset you need to have. Now, how do winning traders handle losses and wins? Well, with losses, they don't take it personally. They analyze if it was a good loss, like they followed their strategy, or a mistake. It was emotionally driven, revenge trading, FOMO, things like that. They don't try to win it back immediately. That would be revenge trading, okay? And with wins, they don't get cocky. They keep a humble mindset. They still follow their plan on the next trade. They avoid increasing risk impulsively, right? They stick to the same risk every single time. Now, the psychology of flow state in trading, top traders often talk about in flow, a calm, focused state where they fully present. There's no overthinking. They trust themselves, right? Trades are executed automatically based on planning and practice, right? Intuition. They enter this state by eliminating distractions, trading with clear rules, managing their energy and mindset, which is like meditation, breaks, and breathing techniques. Okay. And the winning trader's identity, it's like winning traders don't just act like traders, they become traders, okay? Mentally, emotionally, and behaviorally. They believe I am a trader. I execute my edge. I don't chase money. I manage risk and let profits take care of themselves. I am here to play the long term game, okay? Some final thoughts about mastering the psychology of profitable traders. The biggest edge in trading isn't a secret indicator or strategy, it's truly your mindset, your discipline, and your emotional control, right? Those key takeaways are going to be patient and focus on quality, not quantity, you guys. Treat trading like a business, not this quick get rich quick scheme side hustle that you're just trying to make money overnight. It's not like that. Always prioritize risk over reward and journal your trades and emotions so you could detect different patterns and kind of stay clear of those and play the long-term game. Okay, profits, they follow consistency. Your goal is to follow consistency and compound those profits over time. Okay, that's what we need to focus on. So with all of that being said, you guys, now we're going to talk about the only ICT strategy that you will ever need. Okay, let's bring it up. All right, you guys. So we got our charts pulled up. Look at euro dollar. We have talked about this trade in previous video, and look at how it's kind of playing out. It's actually starting to melt and go down. It's pretty crazy. And then USG JPY. This is my baby. This is my bread and butter, you guys. So if we look at UJ, I've broken this down many times. Starting from like the monthly, I always do a top down analysis. So I like to start with the weekly. Right, weekly is my bread and butter time frame. You can do the monthly too, just to give you a little bit of bias. Right. So on monthly, we have this monthly order, not order block, fair value gap right here. Okay, we have a monthly fair value gap here. If we drop to the weekly, we had this bullish turtle soup on the weekly. Boom, boom, boom. And then we had this bullish fair value gap on the weekly as well. This is kind of scaled into the monthly. So the monthly has this fair value gap that we tapped into, and within that monthly fair value gap, we have this weekly turtle soup and this weekly fair value gap. So our strategy is strictly the market maker buy model or market maker sell model. And whenever we have the sell side or the buy side of the curve confirmed, then we're looking for the power of three model, which is going to be accumulation, manipulation, distribution, the open, low, high, close. They're all the same thing. That's the power of three. Okay. So that's referring to the candles. Each candle has an open, a low, a high, and a close, or it has an open, a high, a low, and a close, okay? Depending on the direction of the candle, right? So whenever we know the direction of lower time frame, like if it's going to be the buy side or the sell side, that's whenever we know the higher time frames, open, high, low, close, open, low, high, close, okay? So in this situation, what we're looking for first is a market maker model to give us direction and let us know the bias. So right here on the weekly, right? Price, what we look for first is weekly internal range liquidity to external range liquidity. That's going to be whenever price has a movement higher, it takes out this external range liquidity, right? External range liquidity are like swing lows, swing highs, okay? In this situation, this is a swing high, external range liquidity. Internal range liquidity is liquidity within the leg that took out that external range liquidity, okay? So internal range liquidity is going to be fair value gaps and order blocks, things like that, right? So right here, you see another form of internal range liquidity for me is going to be turtle soups, right? There's this turtle soup right here, and within this big leg, if we look at the monthly, this was a leg of expansion, right? If I really just delete everything right here, this is a leg of expansion, and you can see this fair value gap. It was tapped into in the past by this green candle with this wick, and it respected it and moved higher. That makes this fair value gap valid. And so price came back into it within this internal range, right? This is the leg, and this is the internal range liquidity on the monthly time frame. Now, if we scale to the weekly, right? You could go from the monthly and drop to a daily and look for a market structure shift. So whenever we drop to these time frames, this is when we start looking for that market maker buy model, market maker sell model. And the way that it works is if you've got a monthly internal range or external range liquidity, you drop to a daily and you look for the market maker buy or market maker sell model. And I'll show you what that looks like. If you're on the weekly, you drop to the 4 hour. If you're on the daily, you drop to the 1 hour. If you're on a 4 hour, you drop to a 15-minute. Okay. So what I'm doing right now, I'm not looking for a market maker buy model or anything just yet. What we are simply doing is we are scaling in. Okay. We know that there is this monthly fair value gap, a higher time frame PD array. I call them areas of sensitivity where price can likely find support at and move away from. Okay. We don't know if it's going to hold and if price is going to move away from it just yet. All we know is price can. Price can just melt through it though. We don't know. That's why we look for the market maker model on the lower time frames to confirm that that level is going to hold. Okay. But let's not get too ahead of ourselves. Right now, we are just simply scaled in first. So we are still looking for internal range liquidity to external range liquidity. This allows us to know our bias. This allows us to know what is the next draw on liquidity. If price is moving away from internal range liquidity, it's likely heading towards external range liquidity. If price just took out external range liquidity, it's likely moving towards internal range liquidity, right? So in this scenario, right, being the monthly time frame, tapping into internal range liquidity, from this point, price may likely end up coming to, I'll just bring out this tool, external range liquidity, which is going to be this swing high up here. Okay. We don't know just yet. It's still early in price, right? So right here, we drop to the weekly, and all I'm doing is scaling into that monthly fair value gap. I want to see within that monthly fair value gap, are there any weekly fair value gaps or weekly PD arrays, areas of sensitivity? And like I mentioned, we have this turtle soup right here. It's a form of external range liquidity within the leg. So I deem it an internal range liquidity turtle soup. That's the only time I call it a turtle soup, is if it's like internal range swing low or internal range swing high that price can sweep and then move away from, right? And then another one, internal range liquidity, is going to be this fair value gap right here, right? We have this fair value gap right here. Okay, from this wick to this wick, there's that gap right there. So we scaled in and we found smaller time frame PD arrays within a higher time frame PD array. Now we don't have to drop from a monthly and look for a daily market structure shift. Now we can drop from a weekly and look for a daily, not a daily, I'm so sorry. Now we can drop from a weekly to a 4 hour and look for a market structure shift. Okay, so right here, dropping to the 4 hour, based off of those areas of sensitivity, okay, what do we look for whenever we drop? What we want to see is from the area where price ran out that weekly turtle soup. That's where we start looking for a market structure shift bullish, okay? Everything on this side is currently the sell side of the curve. Okay, this is still selling off, right? We don't know if it's going to go bullish just yet. We need to look for a market structure shift, change in state of delivery. To me, they're all the same. I'll show you what I look for. So from the point of where it runs out that turtle soup, right? This is the line of the turtle soup. Right here, it runs it out. What we're looking for are 3 candle wick swing highs if we're looking for a break above. If we're looking for a sell off, we're looking for 3 candle wick swing lows. In this scenario, we're looking for the highs. So we have this high here. And notice how it does get closed above. Many traders would consider that a market structure shift bullish. Now, why wouldn't you? It also closed above these down closed candles, changing the state of delivery. It also created this bullish fair value gap. It's creating new PD arrays, right? And it's disrespecting old ones. Well, not fully, right? If we notice, there is this bearish fair value gap, this bearish PDA, right? That price closes into, okay? Now, with market structure shifts, a lot of times they will market structure shift and close within opposite PD array. Now, what we need to see is we need to see this PD array get disrespected. I want to see it get closed above to fully confirm my market structure shift bullish, my change in the state of delivery bullish, to let me know that old PD arrays are being disrespected and new PD arrays are being created, and we can then look for them to be respected. In this scenario, you could see it closed within this bearish fair value gap. This next candle did not close above it. I'm like, man, bro, this isn't really disrespecting this bearish PDA. This bearish PDA can potentially hold, and we can confirm that it can potentially hold if this is where I love this, you guys. If the 15-minute market structure shifts, we would continue looking for sales, right? So this is a gem for y'all. This is going to be a diamond right here, okay? Take some notes. When we tap into a weekly time frame, area sensitivity, turtle soup, fair value gap, order block, etc., in that scenario, yes, we are looking for a market structure shift bullish. However, keep in mind, price is currently bearish on this 4-hour time frame. Because it is bearish, we can look for sell opportunities on the 15-minute time frame until the 4-hour market structure shifts bullish and lets us know that it is bullish, and then we will look for buy opportunities. So here, right, of course, this is somewhat counter trend trading. I don't really think so. I think you are just following the order flow, right? You are just understanding what price is doing and what is going on, right? So in this scenario, if we drop to the 15-minute time frame, because remember I told you if it's a 4-hour PD array, 4-hour area sensitivity, we drop to a 15-minute time frame and we look for a market structure shift bearish in this scenario, you guys. So right here, okay, as soon as price taps into that 15-minute fair value gap right there, not 15-minute, I'm so sorry, that 4-hour bearish fair value gap right there, and it market structure shifts, that market structure shift is still just currently a internal range liquidity turtle soup until it is confirmed by breaking that opposite PD array. Until that happens, we are looking for a 15-minute market structure shift bearish. Okay. Now this gets risky, you guys, because we don't know when it's going to fully go bullish. Okay. We are in an area of sensitivity on the weekly. We don't know when the 4-hour is going to go bullish. We are just following order flow right now. So whenever it taps in, looking for that 3 candle wick swing low, we have one right here. And every single time a new one gets created, we just follow it. We have one right here, right? Price doesn't close below it. Instead, we create this new one right here, right? Price doesn't close below it. Instead, we create this new one right here, right? And then it keeps going up. We have these relative equal lows. Relative equal lows also create a 3 candle wick swing low. Okay, right here. It doesn't close below it. Creates this one. Doesn't close below it. Creates this one. And then does that one get closed below? Let's see. It does not. Instead, it creates this one right here. And this one is the one that gets closed below. This is a market structure shift. It also creates 15-minute tiny, just tiny little fair value gap right there. Even if it's tiny, a gap is still a gap. Okay. See how tiny that gap is from this wick to this wick? Both of these wicks. It creates that tiny fair value gap. This right here becomes a mitigation block right here. Okay. Mitigation block because it didn't take out this external range liquidity to become a breaker block. It creates a mitigation block. It's creating new bearish PDAs and closing below these up close candles. And it's also, let's see. Okay, this is where it gets scary, right? So we have conflicting PDAs, right? Now right here, I don't drop any lower. I'm just going to stick to this time frame and manage my risk appropriately. If I take a loss right here, that's okay. It is a cost of doing business for me in these markets, okay? However, you can still drop to the 1 minute. You can look for bullish, whatever. We're not going to get that too deep. Focus right here, right now. 15-minute, okay? So right here, we can see that price. It's not really disrespecting any bullish PDAs. I mean, it did up here. It closed below this fair value gap. It created this bearish fair value gap, respected it, and it's respecting bearish PDAs, you guys. See how much price is just telling you right here? It's closing below up close candles when up close candles, support price lower. It's closing below all these down close candles. You know what I mean? It's closing below these internal ranges. It's creating new PD rays. Like all of this together, you don't just simply look for that market structure shift. You don't just simply look for that change in the state of delivery. It's not just one thing, you guys. You have to apply logic. What is price really telling you when that stuff happens, when a market structure shift happens? Read price. Read it. What is it telling you? Is it printing new PD rays and respecting them? Is it disrespecting old ones? Is it closing below up close candles, creating them as bearish order blocks now? It tells you so much, you guys. Right here, especially if you're in a higher time frame area of sensitivity, like we are, the 4-hour bearish fair value gap, this tells you that price is going to start selling off, right? And right here, whenever this happens, we could look for entry off of that fair value gap. We could also look for entry off of this big order block. And within that, you know what I mean? We also have that fair value gap. Now, I talk about dollar cost averaging all the time. If you are comfortable with risking 1% and there are multiple PD arrays, let's say that there are 3 fair value gaps right here. Take that 1%, split it up into 3 different trades, right? And enter that first 0.33% right at the first PD array and put your stop loss above all 3 PD arrays. If it taps into that second one, enter that second 0.33%. Now, keep in mind, price don't have to go all the way into all 3. Price can tap into the first one and just move away. That is okay. Okay. You are managing your risk and you are applying an edge that you have back tested multiple times. Okay. And in this scenario, my first entry, if I'm risking, so I see 2 PD arrays. I'm going to risk 2%. I'm going to split that into 1% each. I'm going to put my first entry here. Stop loss will go above both of the PD arrays, the fair value gap and above that order block. Yes, it's a big one. Who cares, bro? Right? Who cares? At the end of the day, you are following a edge. My edge says put stop loss above the PD array, the order block, the fair value gap. This is me following the edge. And right here, I risked 1%. If price wants to tap into that order block, give me a little bit of a better entry, then I will take my other 1%. So now I am in 2% on this trade. And for the first trade, I target a 1 to 2R, right? And for the second trade, I could target a 1 to 2R, but 1 to 2R is right here. Okay. What I like to do is if I dollar cost averaged, I expect the first trade to play out. I do not go break even for whatsoever. I will hold to stop loss or take profit. So because of that, I'm going to simply just take this take profit and I'm going to set it to the same take profit as the first trade. Okay. It gives me a better risk to reward opportunity. And you can see both those trades worked out. And look at this, guys. We just sold this bearish when we are looking for bullish 4-hour market structure shifts. It's not ready yet, right? We just got opportunity right here. So now if we drop to that 4-hour time frame, right? Sorry, my camera is shaking so much. I realize that it's on the desk right here. Anyways, whatever. Focus, focus, focus. So right here, it continues to melt. Boom. What is it going from? It went from this 4-hour internal range liquidity, and now it's targeting this external range liquidity low right here, right? Yeah, you can hold your trades all the way for this external range low. However, you guys, we don't know if price is going to come back to our entry. We don't know if price is going to go higher than this. Again, we're looking for a market structure shift bullish. We're in a weekly area of sensitivity. We don't know, right? So don't be greedy with it. Don't try to hold these super big positions for super huge risk to reward ratios. I mean, dude, it's super awesome if you could do it, but only if you can do it consistently. If you do it every now and then, as long as you're still long-term profitable, because again, keep this in mind, if you're risking 1% and you lose 20 trades in a row, you're down 20%. And then you risk 1% on that 21st trade, and that one hits 25R. Now you're back up on your account plus 4%. You made back all that 20% loss, and you're up. You know what I mean? So keep that in mind. I mean, big risk to reward ratios, if you can hit them, bro, hit them. As long as you're making more than what you lose long-term, okay? But with this one, external range liquidity gets hit, and we're still looking for those 3 candle wick swing highs to get market structure shifted above, right? Boom, boom, boom. And it took out external range liquidity. What does it do? It retraces into internal range liquidity, right? What can we do here? This is a 4-hour internal range liquidity. 4 hours is still bearish until 4-hour market structure shifts bullish. We can look for 15-minute sell-off opportunity right here, right? So right here, we go again, and we look for a market structure shift bullish. I mean, not bullish, bearish. Apologies. So right here, it taps in. We're looking for the 3 candle wick swing low. We have one right here. Does create this one right here. It looks like it creates this one right here too. Look at it. Boom. And this one gets closed, but you have this fair value gap that it's respecting. I don't want to see. I don't want to see a market structure shift that's respecting, bullish PDAs. I want to see it get closed below. Notice how this candle closed below it. Now it is disrespected that bearish PDA. You know what I mean? We have that market structure shift bearish. We close below this up close candle right here, and we're disrespecting old bearish PD, old bullish PD arrays. And we are also creating, look at, there's this fair value gap right here. And then there's these ones up here, right? boom, boom, boom. And then look at, there's even turtle soup liquidity right here that price reaches into and whatnot. So again, we don't know what price is going to do, right? We treat this as a whole wave. A lot of people like to apply Fibonacci to get their, what is it called? What is the freaking word for it? Oh my gosh, I am drawing a blank. Um, I forget what it's called. Anyways, you could draw your Fibonacci on here and you could get your premium discount. You know, this is premium price and this is discount price, anything above 50%. I'm still trying to think of what is the word for this. Whenever you apply this, this is, forget it, you guys. I don't want to waste your time. Anyways, you can see that price came into discount. You could take your entry off of this leg, right? Off of this fair value gap. That's totally fine. Dollar cost average, okay? I'm not against that because we don't know what TD array is going to be held. We don't know if price is going to go deeper. We just follow price. We just let price do what it does and we adapt to what it's doing. Okay. So right here, I could take a short position here. And if you want to, you could put your stop loss way above here. That's a really deep stop loss, right? Truthfully, yes, it is. So right here, if you wanted to, you could put it above here. You would get stopped out. It's totally up to you as a trader. What do you prefer? Are you okay with big stop losses or would you prefer to go smaller stop losses? At the end of the day, my goal is to protect my capital. So I want to go with the bigger stop loss, preferably. This is me as a trader. So I'm going to go with the deeper stop loss. Again, I target a 1 to 2R. Okay. 1 to 2R is going to be like right down here, right here, okay? And right here, wow, I can't believe that I hit that too. That's crazy. Anyways, we're focused here. Focus, focus, focus. So here we have a second one. This is going to be a turtle soup. Price turtle soups. You could take an entry off of the turtle soup. And again, we put our stop loss above all three PD arrays. The fair value gap is the where we're putting the stop loss at. I always put my stop loss above the first candle of the fair value gap pattern, which is going to be this candle right here. So I put it above this wick. So we have the second entry just gone down, and I hold this position again for the same risk to reward as this one. Okay, because I expect price to hit this one. Okay, this offers me a 1 to 3R, and then it goes even deeper. Okay, and it taps in here, right? There's our third entry going down. It's like, wow, price really gave us an opportunity on all three. I truly hope it does not go against us fully because right now price isn't looking so good. You know what I mean? That's what we might be thinking in live price. But again, we're just following our edge. We're just sticking to our approach. And this is our approach. And we would hold this one for the same risk to reward. This offers us a 1 to 5R, right? So if you're comfortable with risking 1%, and you split all three of these positions up into 0.33%, you can see that price actually barely missed them. This is a cost of doing business. We took a loss, and that's okay. Now, if you held these ones for a 1 to 2, obviously you were very much profitable on these ones, and you would have hit 0.66, 0.66. That would have been what? 0.12 something minus 0.33. So sorry, I got interrupted. Anyway, so you're at like 1.2 something, right? And then you lose that first trade minus 0.33. You still win about 0.90% on this trade if you only held for 1 to 2R on these. Every video that I make these, it's like these ones, some of these ones will hit if you're just hitting 1 to 2R. Other times they'll hit if you're holding them for this longer term and it's offering you way bigger risk to reward ratios. So for me personally, again, I like to hold them just for this range, right? And for me, I took a 1% loss. I'm okay with that. It's a cost of doing business for me. If I would have won this, it would have been what, 5 times 0.33 plus 3 times 0.33 plus 2 times 0.33. That would have offered a huge, 3%, 4% gain, maybe even, right? I'm not doing all that math right now. But, anyways, from there, price keeps going down, right? We drop to the 4-hour. And from there, once price reacts off of that internal range liquidity, we anticipate it's going to hit external range liquidity. From there, external range liquidity, retraces into internal range liquidity. Now for this one, I'm gonna delete that fib. We would assume the up close candle, right? This is the order block. There is no fair value gap internal range liquidity. Instead, there is an up close candle internal range liquidity order block. And then there's also this turtle soup. This is a great example of an internal range liquidity turtle soup for you guys right here, okay? So it has that internal range liquidity turtle soup. Again, 15-minute market structure shift bearish. That's what we look for here. So boom, it taps into the order block, and then 3 candlewick swing lows way down here, creates a new one right here, creates a new one right here, creates a new one right here, new one right here, and then it closes below it. Boom, closes below it. Market structure shift. However, you see how it still has like this down close candle right here? This is a bullish order block. See how it didn't disrespect that? To me, yes, market structure shift happened, but order block is being held. I need to see it close below this first. You can see it comes up, and new 3 candlewick swing low for me is right here. Boom, disrespects the shit out of it, disrespects that order block, disrespects this fair value gap, this bullish fair value gap even. It's disrespecting old opposite PD arrays, closing bearish, creating this bearish order block right here, this 3 candle sequence right here. This is going to be a little bearish order block because on the higher time frame, it's going to be one single candle. It's going to be one single bullish candle. And then from right here, you can see it closes below, and then we would look for opportunity. It comes up, it doesn't come up into this PD array. Instead, it continues lower and it creates this up close candle here. This is going to be a bearish order block for me. Now, again, you could take sell opportunity here. Short position, stop loss right above that order block, boom, and then we target 1 to 2R. Take profit hit. Beautiful. Beautiful, beautiful, beautiful trade right there, okay? And price is not done yet. It comes up, right? It does an internal range liquidity. So right here, it took out external range liquidity. Boom, we have this fair value gap that price can potentially react off of to continue lower. Now, from here, personally, I've already hit a 1 to 2R. My setup is done, in my opinion, right? But what you can anticipate too is, because this is a market structure shift, you could look at this as a turtle soup, right? Because if you jump to the 1 hour, it is. This right here is going to be like the previous candles, and it's going to be like turtle soup action, right? And again, you can look for more market structure shift bearish. We won't do that. We won't get too deep into that. I don't want to confuse you guys. I'm just showing you guys how you can approach this. We're still looking for that 4-hour market structure shift bullish, and within that, we're finding bearish opportunity, and we're executing on these bearish opportunities right here. I mean, we lost 1%, but we just hit 2%. And then over here, we hit another 2% plus. You know what I mean? So we're compounding this account, and we're following our edge and protecting our capital. And then right here, right? So whenever price is going away from that turtle soup, that internal range, what is it going towards? It's going towards external range liquidity, which is going to be this 4-hour low. That 4-hour low gets taken out, and then it retraces. What does it retrace into? It retraces into that 4-hour bearish order block. That's where we could look for another 15-minute bearish market structure shift right here, you guys. So right here, taps into it, boom, creates the 3 candlewick swing low right here, right here, right here, right here, closes below it, but it's respecting this bullish fair value gap. I want to see that bullish fair value gap get closed below and disrespected. Does not, goes up, creates this one, creates this one, creates this one, and then boom. This right here is the market structure shift bearish. Also closed below this one right here, created this bearish fair value gap right here. Boom. creates another one right here. Boom. And what is it doing? It's creating new bearish PDAs. It's disrespecting old bullish PD arrays. It closed below and disrespected this one. It closed below and disrespected this one. And look at this. This was the one that I told you I wanted to see get closed below and disrespected. Look at it, did that with this candle right here. Boom. And right here, we have two PD arrays. We even have this bullish up close candle. We can consider it three PD arrays. And we can split our 1% up into 0.33. Take our first entry here, put stop loss above that order block right here, because we take into consideration all three PD arrays, and we target a 1 to 2R. Price didn't come up into the second or the third PD array. This is an example of that. Instead, it just went down. We hit a 1 to 2R. So 0.33%, we turned that into 0.66% on this trade setup, and that's okay. Okay, we are obsessing over the process and not the profits, you guys. This is the process of this edge and trading approach, right? So now price is moving away from that 4-hour internal range liquidity confirmed by that 15-minute market structure shift bearish. Where is it heading to? 4-hour external range liquidity. We take that out. Internal range liquidity is going to be that up close candle. And remember, we're looking for those 3 candle wick swing highs. Look at how price closes above that and also creates this breaker block, change in the state of delivery, right? And right here, you guys, we could be like, all right, so market structure shift, this candle closed above. It also disrespected this bearish order block. It closed above it just barely closed above it, but it still closed above it. And it's disrespecting that order block that we found was an area of sensitivity before. So it's disrespecting these old PD arrays. It closed above, market structure shifted, created new bullish PD arrays, this bullish breaker block. For me, once price taps into that 4-hour, again, this is the 4-hour market maker buy model now, and we're taking advantage of that weekly PD array. Now I take my entry off of that order block. There's only one PD array here, so I take that full 1% here and I put my stop loss below that order block, and I'm targeting a 1 to 2R. And 1 to 2R was hit. And now from this point, weekly, we are targeting weekly's external range, right? Which is going to be way up here. Keep in mind, there is this weekly up close candle right here that weekly can find resistance off of and continue down. We don't know that. There is also this one right up here, right? Where it can find resistance and continue down. We don't know that just yet. We have to look for 4-hour market structure shifts bearish off of these areas. And that's whenever we can find an opportunity, right? But now that weekly is expanding bullish, we could go to the daily. And now daily, since weekly is going up, daily should retrace and respect order blocks and fair value gaps that are bullish. So you have this one right here, and then you have this one right here, gets closed above, tapped right back in, and now we're finding opportunity off of it. Whenever price taps into these daily ones, you look for 1-hour market structure shift bullish, right? And so like right here on this old one over here, you would look for market structure shift bullish and get in there. Right now, where it's at, it tapped into it over here. You would be looking for market structure shifts on the 1-hour bullish off of that. And what are you targeting? Daily external range liquidity, right? So for this one right here, we targeted this high. For this one right here, we're targeting these highs. It's beautiful, bro. This is so beautiful, bro. Like, I hope this video made a lot click for you, because this video was so many gems just thrown at you. Know what I'm saying? This video is one of the better videos that I've ever done. Wow. And I just looked at my camera. My camera is all fucked, bro. My camera is wrecked right now. Look at this. Look at this. What's going on? It's lagging and everything. At least you got to see the charts. At least you got a lot of value from the charts. Yeah, you guys, that interruption earlier fucked up this camera. I don't know what's going on now, but I'm gonna end this video, you guys. I hope you got some value from this video. Yeah, you guys are all zoomed in on my face. This is embarrassing. All right, you guys, I'll see you guys in the next video. Later.